Silver is tightening in a way you can actually verify, and that's exactly why the price action is getting treated like a problem instead of a signal. Not because silver can't move, but because once the market admits the supply is shrinking in the places that matter, it can't unsee the math. And later in this video, I am going to give you the clean checklist for the next 1 to 2 weeks. But to watch what level matters, what confirms it, and what would break the thesis, even if the story sounds perfect. Because the headline everyone's staring at is the $100 handle. But the real pressure is hiding in the buckets nobody bothers to separate. And that's where this turns from a hype narrative into a trackable setup. Here's the price context first, because speed changes behavior. Silver didn't just drift higher, it accelerated. We started this year with silver down in the low 70s per ounce on January 1st, 2026. And by January 23, it printed just over $103. That's not a cute rally, that's velocity. And velocity does two things at the same time. It forces shorts to manage margin, and it forces the physical market to reveal whether it can keep up with paper demand without widening stress somewhere else. But that's not the part that matters most. The part that matters is what the market has to do when the price moves this fast into a delivery calendar. Because silver is not just a price, silver is a system. Futures, options, vaults, ETFs, refiners, fabricators, banks, and industrial procurement desks all interacting under different constraints. When you see a move this violent, you're not watching sentiment. You're watching constraints collide. And the constraint that matters is not how much silver exists on Earth. It's how much silver is available, deliverable, and in the right form, in the right place, at the right time, to settle obligations without someone paying up. That's the hidden detail. Inventory isn't one thing. Inventory is categories, and the category that can settle a futures contract or feed immediate demand is not the same as the category that simply exists in a vault. Most people never learn that. They just hear inventories are fine and they relax. But fine depends on which bucket you're looking at and who has claim on it. Some metal is earmarked, some metal is leased, some metal is sitting in a form that is not immediately deliverable into the system you're trying to use. Some metal is technically there, but practically unavailable at the price that matters today. And once you separate those buckets, the story changes. Because the tightness shows up not as a single dramatic number, but as repeated small signals that keep stacking until price has no choice but to reprice higher. And that's exactly what's happening right now. So let's talk about what you can track without trusting anyone's opinion. 3 gauges. They're not perfect, but they're public enough, frequent enough, and connected enough to actual settlement that they'll keep you honest. First, exchange warehouse categories, particularly the split between what's deliverable and what's simply stored. Second, ETF and ETP holdings behavior, because those vehicles mechanically pull metal into custody when demand hits, and sometimes they stop pulling even when price rises, which tells you something important. Third, the term structure and spreads, because spreads are where the market confesses stress. Spot can be theatrical, spreads are contractual. If you want to understand tightening, you don't stare at the headline price. You stare at what it costs to get metal now versus later, and whether the front end of the curve is starting to act impatient. And that's where the real pressure starts. Here's the first mechanism you need, and I'm going to keep it simple. In a normal, comfortable market, the price for later delivery can be slightly higher than the price for immediate delivery, because holding metal has financing costs, storage costs, insurance, and opportunity cost. That's contango. It's the market saying, time has a cost. In a tight market, the opposite can appear. Nearby becomes expensive relative to later. That's backwardation. That's the market saying, I need it now. And not because everyone is emotional, but because immediate access becomes valuable. And if you're short the front month, backwardation is not a vibe. It's a tax. It's because you can't just roll forward cheaply forever when the front end is screaming for material. And silver, more than a lot of commodities, is sensitive to sudden tightness because it's both monetary and industrial, and the physical market isn't infinite. Lead times exist. Refining capacity exists. Logistics exist. Scrap supply isn't a tap you can open overnight. So when the curve starts acting tight, it forces participants to do something specific. Either they pay up for immediate metal, or they scramble to borrow metal, or they buy back shorts, or they incentivize holders to part with bars. Those are real actions, not opinions. But that's not even the full trap. The trap is the calendar, and the calendar is the catalyst. Because tightness doesn't matter evenly across the year. It matters when obligations converge. Month end, quarter end, option expiry, delivery windows, policy events that smack rates and funding conditions. And right now you've got a nasty cocktail. We're in late January, with month-end flows approaching, and a major Federal Reserve decision window in the final week of the month. That matters because silver is not only a metal, it's a rates-sensitive asset through the dollar and real yields, and it's a highly margined futures market where funding conditions change behavior fast. Thin liquidity around key dates can turn normal moves into gaps, and gaps are where the market stops giving you polite entries. That's why the price doesn't need a new story every day. It needs constraints and a trigger, and we have both. The next detail is what flips the whole setup: COMEX delivery mechanics, because this is where paper meets a clock. A futures contract is not a meme, it's an agreement. Most of the time, traders offset before delivery and cash settle their P&L, but the system still relies on the credibility that delivery is possible, and that if enough players choose to stand for delivery, the metal is there or it becomes expensive to source. And the part most people miss is the difference between metal in warehouses and metal that is registered for delivery. If you've ever heard the terms registered and eligible, here's the simplest translation. Eligible is metal that meets the exchange specs and sits in approved warehouses, but it's not committed to settle contracts. It's like a stocked pantry that belongs to someone. Registered is the portion that's been placed in a status that can be delivered against futures. That's the pool the system leans on when contracts turn into delivery notices. And when registered is tight, everything changes, because shorts have fewer easy paths. They can try to entice eligible holders to reclassify into registered, but that's not free. It takes incentives, it takes premiums, it takes trust. Or the short can buy back the contract. That's short covering. And in a fast market, short covering isn't a choice, it's forced buying. Because if margin requirements increase and the front month tightness increases at the same time, the short is paying twice, funding in scarcity. That's where squeezes are born. Not from conspiracies, from constraints. But you're going to hear a counterpoint immediately. COMEX inventories are still huge. And the response is huge compared to what? Compared to total annual mine supply? Compared to global industrial demand? Compared to the number of open contracts that could theoretically demand delivery? Those are different comparisons. And the only relevant comparison is this: how much deliverable metal exists relative to the portion of paper claims that might require it during specific calendar stress? Because if the deliverable category is shrinking, while price is accelerating into a delivery period, you don't need the whole world to run out of silver. You just need a moment where the marginal bar becomes expensive. Price is set at the margin, always. And that's why trackable drawdowns matter even when total stocks look fine. Now, let's stack proof in a way that doesn't rely on one magical data point. Proof point 1 is the price itself, but not in the way retail treats it. The key is the break of a psychological level with speed. Silver crossing $100 is not just a meme. It's a threshold that forces risk managers to update models. Volatility inputs get raised, correlations get re-estimated, option skew gets repriced, VAR limits get hit. Funds that were comfortable, short volatility suddenly aren't. That forces adjustments, and those adjustments flow into futures and options positioning. This matters because in a market like silver, positioning is a weapon. When volatility spikes, dealers hedge differently. If there's heavy call buying or if dealers are short calls, price rises can force them to buy futures to stay hedged. That's not a guarantee, but it's a known mechanism, delta hedging. And when the market is near certain strikes where open interest is dense, the hedging flows can create reflexivity. Price goes up, hedgers buy, price goes up more. That's how math turns into momentum. But here's the catch. That mechanism amplifies. It doesn't originate. The origin is tightness and demand, so we keep stacking. Proof point 2 is term structure behavior, how the front of the curve trades relative to later months. When the curve tightens, the cost to carry shifts, and it becomes harder to roll shorts forward without paying a premium. The curve is a stress gauge. If you see front month strength that doesn't fade, it's telling you there's real demand for immediate exposure or immediate metal, and that ties directly into delivery incentives. Proof point 3 is exchange warehouse category trends. You don't need to memorize the number, you need to watch direction and composition. If total warehouse stock is stable but the deliverable category is leaking, that's a warning. If registered drops while eligible rises, it's telling you owners are reluctant to make metal available at current prices. And if both are dropping, it can indicate metal is leaving the system or being reallocated to places that pay better. Either way, it's pressure. And pressure eventually shows up in spreads and in how hard the market has to work to find supply. Proof point 4 is London Vault data. London is the settlement core for a lot of OTC bullion flows. The LBMA publishes vault totals monthly, and as of end December 2025, it reported about 27,118 tons of silver in London vaults. That number by itself don't tell you tight or loose, because it includes metal held for different purposes and sometimes encumbered by claims. But it does anchor the conversation. The market is not dealing with an infinite pile. It's dealing with a known infrastructure stock that can move, but not instantly. And that S important, because when there was persistent demand for silver in one region or one channel, industrial procurement, ETF creations, or arbitrage flows, London is often the reservoir that gets tapped. If the reservoir is being drawn from, the rest of the system feels it. If the reservoir is steady but the deliverable bucket elsewhere is shrinking, that also tells you something. Metal might exist, but it might not be willing to surface into delivery at today's price. And that's where the price has to do the convincing. Proof point 5 is ETF and ETP behavior. Vehicles like the iShares Silver Trust are designed to reflect the price of silver by holding physical silver in custody. When demand for the shares rises and creations occur, metal is sourced and added. When redemptions happen, metal can be removed. You can watch holdings change. Again, you don't need to worship a single day's number. You need to watch whether the vehicle is absorbing metal over time as price rises, or whether price rises while holdings stall. If holdings rise with price, that's a clear sign of investor demand pulling physical into custody. If holdings stall or even fall while price rises, that can mean the move is being driven more by futures positioning, or that metal is being pulled in one place and pushed out in another, or that the market is tight enough that sourcing incremental metal becomes harder. That's information. And then there's the proof point most people ignore because it's not on a chart, street level symptoms, premiums, delivery times, substitution chatter, industrial buyers adjusting procurement schedules, recycling flows. These don't show up as a neat line on a screen, but they show up as behavior. When metal is abundant, nobody talks about lead times. That's how a volatile, leveraged market shakes out weak hands and forces bad timing. This is where your psychology shield matters. The market will try to manipulate you emotionally with volatility. First, it will spike and make you feel late. Then it will pull back and make you feel stupid. Then it will bounce and make you chase again. That cycle is how people lose money even when they're directionally right. So the mental model you need is trend signal versus noise. Trend signal is the structure. Higher highs and higher lows, pullbacks that hold key breakout zones, spreads that remain firm, and tracked inventories that continue to show tightness in deliverable categories. Noise is the intraday violence, the headline-driven whips, the sudden flushes that happen when liquidity thins or when margin gets raised. You can't eliminate noise. You can only stop letting it drive your decisions. And the way you do that is by anchoring to confirmable signals instead of feelings. So what are the confirmable signals over the next 1 to 2 weeks? Here's the near-term roadmap. And this is where we stop being poetic and start being operational. Watch the behavior around the prior breakout area. In a parabolic move, the most common healthy sequence is a pullback, then a retest, then continuation. Scenario 1 is the controlled pullback and retest. Price cools off, volatility compresses a bit, and buyers defend an obvious zone instead of letting it collapse. In that scenario, the curve tends to remain relatively firm near the front, and any inventory category tightening doesn't suddenly reverse. ETF holdings may stabilize or grind higher rather than bleeding. The tape looks messy, but the structure remains intact, and that's the setup that can reload without blowing itself up. Scenario 2 is the continuation squeeze. That's where price doesn't give you much of a pullback, where it pulls back briefly and then rips through recent highs again. In that scenario, gap risk increases, especially around thin liquidity periods and key event dates. Dealers adjust hedges fast. Shorts cover fast. Spreads can tighten further. And the market becomes less about should I buy and more about can I get filled without paying the tax. Scenario 2 is where a lot of people get emotionally destroyed because they either chase too late or they fade too early. But the key is this. Both scenarios can exist inside a broader tightening thesis. The difference is timing and path. Your job is not to predict the path perfectly. Your job is to know what confirms and what invalidates, so you can respond instead of react. So let's define the invalidation logic, because this is what separates market adults from market tourists. Tightness narratives break when the stress gauges relax. If the front end of the curve softens meaningfully, if nearby spreads stop acting tight and start acting comfortable, that weakens the immediate scarcity argument. If deliverable categories and exchange warehouses suddenly rise sharply for a sustained period, that suggests metal is being mobilized back into deliverability at current prices, which can cap upside and cool squeezes. If ETF holdings bleed persistently while price fails to make new highs, that can indicate the move was more positioning driven than physical driven, and it becomes more vulnerable to reversal. And if macro conditions shift violently against metals, say a hawkish policy shock that drives the dollar and real yields sharply higher, that can create a liquidation wave that overwhelms the tightness story temporarily. Notice that word, temporarily, because macro can dominate on short horizons even when supply constraints exist. Again, trend versus noise. A policy shock can create noise that breaks weak hands. But if the supply constraint is real, the market often rebuilds and grinds back, because end users still need metal and the physical market still has to clear. But don't confuse eventual with easy. Price can absolutely dump 10% or 20% in silver and still be in a bull structure. That's why risk management matters. Now, let's get very specific about the why now calendar trigger, because this is the piece the mainstream will miss while they argue about narratives. Late January has 3 features that matter: month-end positioning, policy risk, and liquidity conditions. Month-end means systematic funds and allocators rebalance, and it can create mechanical flows. Policy risk means rates and the dollar can lurch, which changes the funding math for leveraged positions and changes the attractiveness of holding metal versus holding cash. Liquidity conditions mean that when markets are crowded and volatility is elevated, liquidity providers widen spreads and reduce size, which makes every move bigger than it should be. Put those together in a silver market that has already proven it can jump from the 70s to over $100 in 3 weeks. And you have a setup where even small incremental tightening can cause outsized price reactions. And this is the part people won't say out loud. When volatility rises, exchanges can raise margin requirements. That's not a conspiracy. It's standard risk management. But the effect is brutal. Higher margin means some players must reduce positions. If they're long, that can cause forced selling. If they're short, that can cause forced covering. In a tightening market, forced covering is the gasoline. And it often happens at the worst time for the short, when price is already moving against them and liquidity is thin. That's why these moves look like overnight miracles. They're not miracles, they're margin math plus scarcity signals. So if you're watching this as a retail investor or a macro watcher, here's the clean way to approach it without getting emotionally hijacked. First, stop treating the $100 handle like the whole story. It's a psychological level, yes, and it matters because it changes behavior. But the real story is whether tightening signals persist after the initial celebration. Second, pick the handful of trackables and check them like a pilot checks instruments. You're not trying to be right on every tick. You're trying to avoid being blind. Track the warehouse category split directionally. Track whether the front end of the curve remains firm. Track whether big physical vehicles are absorbing or bleeding metal. Track the way the market behaves on pullbacks. Does it get bought quickly, or does it slice through prior zones like they never mattered? Third, decide in advance what would make you change your mind. That's your shield. Because if you don't decide that in calm moments, you will not decide it in chaos. You will decide it in fear. And fear is expensive. Now let's address the best counterpoints, because this is where trust is built. Counterpoint 1, silver is up too much too fast. It has to mean revert. That can be true on path, not necessarily on trend. A pullback is plausible. In fact, in a healthy bull structure, pullbacks are normal. The question is not whether it pulls back. The question is whether pullbacks are shallow and defended, or deep and cascading. Counterpoint 2. Inventories are reported, so if there's a real shortage, it would be obvious. Not necessarily, because reported totals can mask availability. Categories matter. Encumbrance matters. Location matters. Form matters. A bar in one place might not solve a delivery obligation in another without time and cost. And time and cost are exactly what gets repriced in spreads. Counterpoint 3. Industrial demand is cyclical. A slowdown could free up supply. Yes, that's a real risk. If industrial demand weakens meaningfully, it can relieve tightness, but watch how quickly supply responds. In a byproduct-driven supply chain, supply doesn't instantly surge just because demand dips and inventories can remain constrained. Counterpoint 4. If this was a real structural tightness, why didn't the market price it earlier? It did, just not in the way people expected. Markets often price constraints in phases, first in spreads and availability, then in volatility and positioning, then in headline price. Retail sees the last phase and calls it sudden. Your professionals see the earlier phases and call it inevitable. The market is not always efficient in time. It can be efficient in price once constraints become undeniable, and that's what you're watching now. Okay, so what comes next in practical terms? Over the next week or two, the key is whether silver can digest the move above $100 without giving it all back. Watch for 2 behaviors. 1, consolidation that holds above a meaningful support zone, with buyers stepping in and volatility gradually compressing. 2, the absence of a deep flush that breaks structure and coincides with a relaxation in tightening gauges. If silver consolidates and spreads stay firm, that suggests the market is not done repricing the constraint. If silver flushes hard but spreads and deliverable tightness remain, that can be a shakeout rather than a thesis break. But if silver flushes and the tightness gauges relax at the same time, that's your warning that the move was more positioning and less physical. And the level that matters is not one magic number carved into stone. It's the zone created by the breakout and the first major retest attempt. That zone becomes the battlefield. Hold it, and the squeeze option stays open. Lose it decisively, and the market may need more time to rebuild. Because if this one level breaks, the math changes. And here's the subtle truth that keeps people from getting wrecked. You don't have to catch every dollar of upside to be right. You just have to avoid getting forced into bad decisions by volatility. Silver is notorious for punishing certainty. It can rally hard, then punish late longs, then punish early shorts, then punish everyone with chop. The only people who survive are the ones who respect structure, respect signals, and respect the calendar. That's why you're here. You're not here for a fairy tale. You're here for mechanics. So here's the checklist I promised. The tight, no excuses version. 1. Confirm the trend structure on pullbacks. If the market holds and reclaims quickly after dips, that's strength. 2. Watch the front end of the curve. If nearby remains firm relative to later, scarcity is still being priced now. 3. Watch deliverable versus non-deliverable inventory categories directionally. If deliverable tightness persists, the pressure remains. 4. Watch physical vehicles and flows. Sustained absorption supports the tightness narrative. Persistent bleeding challenges it. 5. Respect the calendar. Around month end and major policy events, expect gaps, expect whips, and do not confuse volatility with invalidation. That's the playbook. And if you want the quiet advantage most people never develop, it's this. Stop trying to win arguments about silver and start tracking the few variables that force real participants to act. Because when you track what forces action, delivery deadlines, funding conditions, spreads, and availability, you stop being the exit liquidity for someone else's better plan. You become the person who sees the setup early, stays disciplined through noise, and knows exactly what would change the story. That's the kind of investor the market can't easily exploit. And if you're building that skill set, you're already in the right crowd. The crowd that watches the mechanism, not the mood. Stay with that crowd, keep your eyes on the instruments, and let the market tell you the truth through the signals it can't fake forever.